There is a page in your mortgage closing documents that most people turn past in under 5 seconds. It is a full disclosure. It has been legally required at every closing table in America for years, and it contains a single line that answers a question almost no one thinks to ask. The line is called total of payments. On a typical home purchased this summer, that number is over $800,000 for a house that cost $440,000. You signed next to it, you initialed it, and you were told correctly that you were making the responsible choice. Both of those things can be true at the same time, and that is what this episode is about. I am going to show you exactly why the standard American mortgage runs for 30 years, who decided that when they decided it, and what that one number 30 was actually calibrated to produce. It was not calibrated to produce your equity. Here is what you believe, and here is why believing it makes sense. The 30-year fixed-rate mortgage is the responsible product. It is the one your parents had. It is the one your lender presented first, the one the online calculators default to, the one your real estate agent assumed before you said a word. It keeps the monthly payment manageable, which means you can buy a home without gutting the rest of your financial life. It is fixed, which means the payment never ambushes you. It is predictable, boring, and everywhere, and in personal finance, boring and everywhere usually signals safe. And the belief has real support underneath it. The 30-year term genuinely does lower the monthly payment. It genuinely did open homeownership to millions of families who could never have carried a shorter loan. Nearly every mortgage written in court today is built on this template, and an entire regulatory apparatus exists around it. When something is this universal, this endorsed, and this old, the reasonable conclusion is that it survived because it works. You did not choose the 30-year mortgage carelessly. You chose it because every signal in the environment, institutional, social, parental, told you it was the sensible default. Defaults feel like neutral ground. They feel like the absence of a decision rather than the presence of one. That is the comfort. The term is standard, therefore the term is neutral. Therefore the only real question at the closing table is the interest rate. Rate is the variable. Term is just furniture. Almost everyone who signs a mortgage believes some version of this, and almost no one interrogates it, because the term was never presented as a decision in the first place. Now the crack. It is a small one, and it comes from your own paperwork. In July 2026, the average 30-year fixed mortgage rate in the United States is 6.49%, according to Freddie Mac's weekly survey. The median existing home, according to the National Association of Realtors, now sells for $440,600, an all-time high. Put 20% down, and you borrow $352,480. At 6.49% over 30 years, the monthly principal and interest payment is about $2,226. Multiply that by 360 payments, and you get roughly $801,000. The interest alone comes to about $449,000. Read that again slowly. The interest is larger than the loan. You borrow $352,000, and you pay $449,000 for the privilege of borrowing it. The financing costs more than the thing being financed. On the median American home, at the average American rate, on the standard American term, the bank's share of the transaction exceeds the seller's. Here is the part that should bother you more. The 15-year version of the same loan, at this summer's average of 5.82%, carries total interest of about $177,000. Same house, same borrower, same lender. The difference between the two terms is roughly $272,000 in interest, a gap larger than most Americans' retirement accounts. And yet one of these products is the default, the one pre-selected on every calculator and every rate sheet, and the other is the alternative you have to ask about. If the term were neutral furniture, you would expect the default to be arbitrary or to favor the borrower or at least to sit somewhere in the middle. It does not. The default is the single term among all commonly offered options that produces the maximum total interest. That could be a coincidence. Sit with the discomfort of not knowing yet whether it is. The mechanism has a name: mortgage duration design. It is the deliberate calibration of loan length as a revenue variable, and to see it clearly, you have to know where the 30-year term came from, because it did not come from nature. Before the 1930s, the American mortgage was a completely different animal. Loans typically ran 3 to 5 years. Most were interest only. At the end of the term, the entire principal came due in one lump sum, a balloon payment, and the standard practice was to refinance into a new short loan rather than actually pay it off. This worked as long as banks kept lending. Then the Great Depression arrived. Banks stopped refinancing. Millions of balloons came due into a collapsed economy, and foreclosures tore through the country. The system had failed so completely that the federal government rebuilt it from the ground up. The Federal Housing Administration was created in 1934, and with it came the innovation that defines your financial life today: the long-term, fully amortized loan. FHA-insured mortgages ran 20 years, then 25. Congress did not authorize the 30s firm term until 1948 for new construction, and not until 1954 for existing homes. Even then, adoption was gradual. The average FHA loan term between 1946 and 1954 was about 21 years. The 30-year mortgage as the universal American default is not a Depression-era safety measure. It is a mid-century extension of one, and each extension of the term was justified the same way. It lowers the monthly payment so more people can buy. That justification is true. It is also incomplete, and the incomplete part is where the mechanism lives. Amortization is not linear. Every monthly payment on a fixed mortgage is split between interest and principal, and the split is calculated on the remaining balance, which means the early payments are almost entirely interest. On the loan we priced earlier, the very first payment of $2,226 sends about $1,906 to interest and $319 to your balance. Roughly 86% of your first payment does not buy you one brick of your house. This front-loading is not new to you if you have thought series from the beginning, but duration design is what weaponizes it. Stretching a loan from 15 years to 30 does not double the interest-heavy period. It multiplies it, because a longer term means the balance declines more slowly, which means interest is charged on a larger balance for longer, which slows the decline further. On the 30-year loan we priced, your monthly payment does not send more money to principal than to interest until month 233, year 19. You spend nearly 2 decades on the wrong side of your own payment. Here is a question worth holding on to while we go deeper. When your lender showed you what you could afford, what number were they pointing at, the monthly payment or the total of payments? Remember your answer. It matters at the end. Now, who profits from the duration itself? Start with the arithmetic. At current rates, each additional year of term adds interest revenue while lowering the monthly payment by a shrinking amount. The move from 15 to 30 years cuts the monthly payment by about $715 in our example and adds about $272,000 in total interest. The borrower experiences the $715 every month. The $272,000 is experienced by no one because it is spread across 3 decades in amounts too small to register. Duration converts an enormous cost into an invisible one. That is not a side effect. That is the product working. Then follow the loan after you sign it. Your bank almost certainly does not keep it. It is sold into the secondary market, packaged with thousands of others into mortgage-backed securities, and sold to investors who are buying exactly one thing: a long, predictable stream of interest payments. The 30-year term is what makes that stream long. Servicing companies collect fees on every payment. For as long as the loan exists, longer loans, more payments, more fees. Every institution in the chain, from originator to servicer to bondholder, earns proportionally to the duration of your debt. None of them earns anything from your equity. Your equity is the one output of this system that generates revenue for no one but you. And it is the output, the system's central design choice, the term was calibrated to slow down. And notice what the 30-year term does to the price of housing itself. Because buyers shop by monthly payment, a longer term raises what any given household can bid. When every buyer's bidding power is stretched by the same instrument, sellers capture the difference. Prices rise to absorb the new capacity, and the affordability the longer term promised is competed away, leaving only the interest. The term was sold as a ladder. Structurally, it behaves as a lever that transfers the gain to sellers and lenders while leaving the borrower with the duration. Consider a case. The people in it are a composite built from median transaction data and homeowner tenure statistics, not a documented couple, but every number in their file is real arithmetic. Elena Marsh is 41. She is a hospital operations manager. Her husband Dean is 43, a logistics coordinator. Combined household income, $154,000 a year. 2 kids, 9 and 12. In the summer of 2026, they buy a house for $446,000, the national median, almost to the dollar. They put 20% down, money assembled over 9 years of deliberate saving, and they take the loan every institution in their life expects them to take. $352,480, 30 years fixed, 49%. The decision is rational at every step. The monthly payment of $2,226 fits cleanly under the affordability thresholds their lender applies. The 15-year alternative comes up exactly once. In a single sentence is always framed. It would cost $715 more per month, not. It would cost $272,000 less in total. The same fact stated from the other end, and the end it was stated from decided the outcome. The Marshes want that $715 available for 2 kids approaching their teens, so the conversation lasts under a minute. Their loan officer is honest and competent. Their agent is pleased. Their parents are proud. Elena reads more of the closing stack than most people do, and she does see the total of payments line. She registers it the way you register the ocean from an airplane window. Technically enormous, practically abstract. The number that feels real is 2,226. That is the number that has to clear the account on the first of every month, and it does. For years it does. The Marshes are not reckless. They never miss a payment. Every January a statement arrives showing the year's interest for their tax return, and every January the figure is over $20,000. And every January it is read as a deduction rather than as a cost, which is its own small piece of design. They believe, because their statements encourage the belief, that each payment is steadily converting debt into ownership. The statements never lie. They simply never volunteer the shape of the curve. 12 years pass. This is not an arbitrary interval. 12 years is the median length of time an American homeowner currently stays in a home before selling, according to Redfin's tenure data. In 2038, Dean's employer consolidates operations 2 states away, and the Marshes list this house. Elena calls the servicer for the figure, expecting a small number. They have paid $2,226 a month for a 144 consecutive months, $320,486, nearly the full original loan amount, out of their account, and statement says they still owes $83,159. She checks it twice. Then she does the subtraction that 12 years of statements never quite invited her to do. Of the $320,486 they paid, $251,165 was interest. The amount that actually reduced their debt, the amount that became theirs, is $69,321, roughly 21 cents of every dollar they sent. They lived exactly the median American homeowner's timeline, and the median timeline ends here, at the moment of sale, still inside year 12 of a curve that would not have tipped in their favor until year 19. They sold the house before their own mortgage ever started working for them, and the structure of the loan meant that was always the most likely outcome. The house appreciated, and the sale is not a catastrophe. But standing in the kitchen with the payoff statement, Elena is somewhere specific, a state you could call arithmetic disbelief, the vertigo of discovering that a number you watched for 12 years was never measuring what you thought it was measuring. She does not know, yet, what they will do at the next closing table. There will be a next closing table, and the paperwork waiting on it will be identical. Now scale it, because the Marshes' 12 years are not an anecdote. They are the system's operating condition. The median American homeowner sells after about 12 years. The interest-heavy phase of a 30-year loan at current rates lasts about 19. Hold those two numbers next to each other, and the national picture resolves. The typical American borrower spends their entire time in a home, inside the front section of the amortization curve, the section engineered to be almost all interest and exits before reaching the section that builds equity efficiently. This is not a minority experience or a stroke of bad luck. It is the statistically normal path through the product. The 30-year mortgage's profitable years and the American homeowner's actual years are the same years, and the exit is not an exit. Follow a hypothetical borrower, and let me label this clearly as a hypothetical, who buys at 32, sells at 44, buys again, sells at 56, and buys once more. 3 homes, 3 closings, 3 30-year loans. Each sale resets the amortization clock to month 1, where 86% of the payment is interest. This borrower can make mortgage payments for 40 consecutive years and spend nearly all of them in the steepest part of 3 different interest curves, without ever once reaching year 19 of any of them. On paper, they held mortgages for 4 decades. Structurally, they spent 4 decades perpetually at the beginning. Multiply that pattern across roughly 85 million owner-occupied households with mortgages, feed the payment streams into the securitization pipeline, and you have one of the largest fixed-income markets on the planet, trillions of dollars of mortgage-backed securities, whose value rests on Americans doing exactly what the Marshes did: paying reliably, moving on the median schedule, and restarting the curve. The system does not need you to fail. Foreclosure is expensive and messy. The system needs you to succeed slowly to be exactly the kind of responsible, employed, forward-moving family that pays for 19 years without ever arriving anywhere, then begins again. Duration also traps in the other direction. The millions of households who locked rates below 3% during the pandemic now cannot afford to move, because moving means trading a rate they will likely never see again for one in the mid-6s. The long term that was sold as flexibility has hardened into geography. It holds inventory off the market, keeps prices elevated, and quietly decides where people are allowed to live. A 30-year contract does not just price your house. It prices your mobility. Watch where the industry innovates, and you can see the incentive with your own eyes. When affordability tightens, the response is never a cheaper house or a shorter loan. It is a longer one. 40-year loan modifications already exist in the government's own toolkit, and 40-year products circulate at the industry's edges, marketed in the identical language that carried the term from 20 years to 25 to 30. It lowers the monthly payment. Duration is the industry's answer to every affordability problem, because duration is the industry's revenue. The dial only ever turns one way. So redefine the thing you sign. You were taught to see the mortgage term as a repayment schedule, a container, neutral in itself, whose only meaningful property is how long it takes to empty. Under that definition, 30 years is simply a slower 15. Same product, gentler pace. That definition is wrong, and the numbers you have seen tonight prove it. A term that produces $177,000 of interest and a term that produces $449 of interest in the same loan are not the same product at different speeds. They are different products with different prices, and the difference in price, $272,000, is larger than the down payment, larger than most inheritances, larger than what most households will ever hold in a retirement account at once. The term is not a schedule. The term is a price. Duration is the mechanism through which the true cost of a mortgage is set, and the monthly payment is the mechanism through which that cost is hidden. This is why the industry's entire vocabulary of affordability points at one number what you pay per month and never at the other what you pay. A product that costs $801,000 was successfully sold to you as a product that costs $2,226, and the instrument that performed that conversion was time itself. 30 years is long enough that no single month ever feels like $449,000. That is what the 30 years are for. And once you see the term as a price, the closing table changes shape. You thought you were negotiating the rate, while the term sat in the background as furniture. In reality, the term was the largest financial decision in the room, larger than the rate, larger than the purchase price you haggled over, larger than any decision you will make about the house afterward. It was the decision that determined whether the bank side of your transaction would be modest or would exceed the value of the home itself. And it was presented to you as a default, not argued for, not compared, pre-selected, pre-printed, and slid across the table inside a stack of pages you were given an afternoon to sign. Redefine affordability while you are at it. Affordability, as the industry uses the word, means the monthly payment clears your income thresholds. It is a statement about the lender's risk, not about your cost. A loan can be perfectly affordable in that vocabulary and still be the most expensive purchase of your life, be a factor no other decision will ever approach. The word was never measuring what you thought it was measuring. The most expensive number in your financial life was never discussed. It was assumed. Here is where this leaves you. The rate was negotiated. The price was negotiated. The term, the variable that cost more than either, arrived pre-decided, calibrated over decades by institutions whose revenue is measured in your duration. You chose the term that costs you the most, and you never experienced it as a choice at all. If you own a home, have you ever read the total of payments line on your closing disclosure, and what did you feel in that moment? I'd like to know in the comments. One more thing. The mortgage is one commitment. Now count the others stacked on top of it, wired into it, depending on it. Why does cutting any single one impossible, even when the math says it shouldn't? There's a reason, and it isn't willpower. That's next.